we're going to welcome Blake Winburn, partner of Orrick, to the stage to lead an interview with Mark of Climate Investment. And then for the afternoon, as we have Blake and Mark take stage, we're going to move into tracks. So for those wanting to stay in session A, this will remain as session A. And for those wanting to go to the CVC development workshop, that will be in the Monterey Ballroom across the parking lot. So to that point, we're going to talk about climate. And we're going to see what's going on with climate investment. So Mark, please take stage, and I'll let Blake introduce you, and you can expand on the opportunities to be working with climate investment.
All right, okay. Thank you.
Is it there?
Right here. How about you can go here. All right. Thank you very much. I'm Blake Winburn. I'm with Orrick. I head up our energy and infrastructure practice and based in our Houston office, and so pleased to be here with Mark today, but also thank you to GCVI. We're very proud at Orrick of our long partnership, not only with GCVI and the team there, but also with many of you in this room. So very good to be here, and thank you for having us. Mark, maybe what we'll start off today is we'll think about the theme that we'll kind of get through our discussion here is maybe thinking about it in terms of journeys. And Mark, we'll start with your journey first, a journey that's taken you from a very interesting vantage point at Vantage Point Partners and DBL and 40 North. And so you've seen this evolution, and just maybe talk a little bit about what that journey's been that's gotten you to climate investment at this point.
Yes, it's always so easy to talk about your own journey. Thanks, Blake.
Start with the easy one.
And thanks to all the GCVI folks and all the other sponsors, Orrick included. And it's great to see so many people that I've known for years. I guess I've been in the venture space about a quarter century, always focused on either climate or clean tech. That endeavor was born out of 3 Silicon Valley startups, all in the non-Silicon Valley traditional areas, so industrial chemicals, industrial lasers, and environmental remediation. And I think I was like 40 and my third startup got acquired by a publicly traded chemical company. Mm-hmm. And it was fine. I was running a P&L there. Not really that excited about running a P&L, but they said, look, you're based in Silicon Valley. Why don't you run our venture capital program too? Because you're in Silicon Valley, therefore you must know. And I said yes, but of course all I knew was maybe how to raise money, not who to give it to. So I did some corporate CVC type investing, not necessarily in climate tech, back in the early 2000s.
Right.
Liked it enough to then try it full time. So 7 years at Vantage Point, we had 6 funds, $4 billion of AUM, diversified generalist fund. But I ran with Stefan Dolezal, the clean tech practice there.
Right.
And then I was very fortunate enough to partner with Ira Ehrenpreis, who was here last night, at both Tech Partners and DBL for about 7-8 years. I learned a lot from Ira and my colleagues there, and then started my own firm, 40 North Ventures, an industrial family in New York, and then failed miserably at retirement in my 60s, and then got a call from CI and said, come help us with our climate practice, and you got some relevant background, and 3 years later, I'm still there.
There you go.
Yeah.
Right, which leads us into our next journey, which is actually CI's journey.
Yeah.
So really initiated under the nomenclature Oil and Gas Climate Initiative, OGCI. So the CI is still there, but the Oil and Gas Climate Initiative was really fostered by oil and gas corporates getting together, thinking about innovation and how to foster that innovation. So creating a common pool, but really trying to make a difference in some of these early stage technologies, but not necessarily a long-term investor. And so that evolution and that journey from OGCI to now climate investment, there's a lot different about it, and a lot different than just the acronym and the CI remaining in the acronym. It's really fundamentally different how you're thinking about investments and what that approval process is and the capital that you're pulling together. So maybe talk a little bit about the transition.
Yeah, I think evolution is the right word for us.
Yep.
So OGCI, Oil and Gas Climate Initiative, was born in 2017.
Right.
In a non-traditional manner, they were awarded $1 billion fund to go find people to invest in. So a little bit like the butterfly that has the cocoon cut open, didn't have to go out and raise that capital. And so the first incarnation was, okay, how do we build a platform?
Right.
And we had our own natural early stage adolescent fits and starts, eventually coming to the conclusion that many of you know in this room, that venture capital is really about human capital. And human capital is about the team that you put together and their unique abilities due to both access to great entrepreneurs and maybe some of their own insights.
Right.
And so in the 2018-19, as we were understanding that evolution, we brought on groups of folks to become parts of the investment team. We added a commercialization effort and a technology effort. And what was clear to us at the outset was that we had the 11 largest oil and gas firms on the planet backing us with very patient capital. We had, I think, a team that was being built out of the foundations of Cleantech 1.0,
Right.
where we all learned that it was impossible to guess at which the money round was going to be. So if you were going to invest in an industrial 4.0 clean tech startup, you better be prepared to play the long game. So if you're going to do a Series A and B, but not a Series D and E, you better be really, really clever or really, really lucky. So we took the $1 billion approach and we said, let's just don't spray and pray it. Let's be focused, do 2 dozen, 3 dozen companies, and let's make sure that we have capital to participate in every entrepreneur's journey, from innovation idea to global scale. And we use the resources of OGCI, the resources of now CI, both
Right.
technical and commercial, to help that happen. I think if you look at our team, one thing that I would advertise, besides they're just wonderful people, is that almost everyone has been an entrepreneur, an operator, or a technologist, as well as a successful investor. And ideally, they've been all four. And we make that a stipulation upon coming in, because I think I was telling Blake earlier, entrepreneurs can smell empathy and they can smell experience. And if I can offer them that we have capital for your entire journey and we have people that are going to deliver the capital who have lived your journey, I think that puts us in good stead, both in the boardroom and with entrepreneurs.
Yep. And even within that framework, though, if you think about comparators in the market,
Yeah.
and you can think at one end of the spectrum, all represented in this room, more of a financial player, financial investor fund. Other end of the spectrum, perhaps, a corporate venture capital sort of organization. Given the way that CI operates, it really is, in a lot of ways, between those two things in terms of where it's raising capital from, the corporate side,
Right.
but also the way you administer the fund and make investment decisions and have discretion that is separate and apart from your LPs. Feels more like a financial player. So
I think that's,
yeah, fair enough. I mean, is that?
you asked and answered the question.
Yeah, I mean, it's the brilliant of
Well
my
done.
question.
Well
Yeah,
done.
exactly. Yes, I agree.
I think hybrid is a good word
Yeah.
I've used often. So,
Yeah.
you know, at its foundation, we were set up for the long game. So there isn't going to be a sudden corporate sort of C-suite change of heart. And so as a result of that, we were able to make sure that there was the appropriate amount of autonomy for the investment decision process and for the continuing capital. So I think one of the things that I learned in corporate VC life, all the way back to doing a number of investments with Dow Chemical back in the 90s, is the consistency of both the partner and the platform. And I think you heard a little bit of that on the last panel. It is so true and so important, both to get the right people to help make the right investments, but also make sure that the entrepreneurs believe that you're going to be there for them. So the autonomy that we've gotten has a level of governance and reporting, and that's all good. Your LPs matter,
Right.
and so do your entrepreneurs. If I wake up every day and I think about just those two things, I'm probably doing my job at least
Right.
the best I can.
Right.
We've been able to diversify further. Some of my colleagues, Katja Platniskova and Josh Hacker, are here. We've since announced the first close on a very large growth equity fund,
Right.
which has a hard cap of $750 million, and we will be doing a first close of a new venture fund later this summer. So that'll give us 3 funds, and as a multi-fund manager, there's a natural level of GP-LP relationship that will continue to evolve for us as we grow and as we build the team. We are also in London, New York, Houston, San Francisco, so
Right.
we're rather global and diversified in our approach, and that gives us a little bit more autonomy as well.
Absolutely. And just on that point, too, as you diversify who that LP base is, starting off with oil and gas majors.
Yeah.
It becomes more industrials, more manufacturing, more in the energy business. Maybe it's on the transportation side or transmission side. And so you're creating this big pool of LP capital, but also you have an opportunity to use the resources that are part of those LPs, the expertise,
Yep.
the understanding of regulatory environment, the participation in political understandings. And so there's an access that is not contingent upon anything, but it gives you a resource base of information and ways to expand your knowledge and the opportunities that you're pursuing.
Yeah, it's a good, first of all, well said, and it's a
Yeah.
good characterization. I'd like to think that we can be a little bit of a Chinese menu in the way we approach that. So,
Right.
so obviously our LPs have a lot of global presence. They have their own capital. Many of them have their own venture capital platforms. And we do work with them both on investments.
Yep.
Some they lead, some we've led. We have what I would call a collaborative culture with them. And then with the corporates, what we like to do with our commercialization teams is help our entrepreneurs see how they can scale their businesses globally. And so if you think about the 11 LPs we have, the additional half a dozen new LPs we have in our growth fund as we diversify, they are big international companies.
Right.
They have skills that our entrepreneurs will eventually hope to value.
Right.
But there are no conditions on the LP's money
Right.
for the entrepreneur. So we say Chinese menu in the sense of what can we do for you? What can I do for you? But what can our LPs might do for you? And so we have a commercialization team, much like you heard from the former panel, that
Right.
goes in and has its own relationships with the management team members. And I think that's worked out really well. I think we've got like 37 portfolio companies. I think we've got like 140 pilots and or customers that are out of our ecosystem today. And I'm not sure that would have been that easy to do if we were a truly just financially backed
Right.
investment firm.
Absolutely. Absolutely. Well, I mean, it does set up a little bit, maybe a conversation around our third journey for today. And the journey is clean tech, and where have we come from Clean Tech 101? And where do we sort of find ourselves today? And you mentioned it. I mean, a big part of that is the challenge is scaling. How do you go from a seed round, an A round, actually to steel in the ground, demonstration plant, raising capital, and what that journey looks like?
Yeah.
So obviously Clean Tech 1.0 or whatever the nomenclature is, and for reasons that weren't specific to the thing, there's a lot of macroeconomic stuff happening at the time, so there's not a single point of blame. But when we think about that journey today, and you thinking about it from where you sit, particularly with the momentum of climate investment behind you, what do you see are some of the opportunities and challenges that are rolling out of that?
That's a really good question, Brian.
I'm knocking it home.
No, no.
On the question.
I'm sure that a lot of folks in the audience have their own views of this.
Yeah.
Having lived through the first clean tech wave, which many people in Silicon Valley thought was going to be the greatest, economic opportunity of our lifetimes, and I believed it as well. What people didn't understand is that the investment time was going to be your lifetime. So that was the challenge. And so underwriting and handicapping industrial innovation has never been easy.
Right.
If you go back to General George Doriot and American Research and Development Corporation back in the 60s, they were doing railroads and airplanes. And their notion was this is illiquid asset private equity. So be prepared for the long game. So I think what we've looked at is the climate problem has not gone away. It's amplified now.
Right.
There are lots of things you could point to on policy and regulatory tailwind. We try not to underwrite against that. We try to use that, but not underwrite against it. What we do try to point out is that the entrepreneurs that we see today are so much better equipped than they were 25 years ago. First of all, they have unparalleled access to human capital that they never had before. They have basically free and unlimited computational power.
Right.
And I'm not talking about AI. We have a number of investments in that space. I just mean you can go to the cloud and you can buy all kinds of processor power you want for nothing practically. And those information technology layers, the Cray computer that you and I were trading texts on, right?
Right.
That everyone wears on their hip, it didn't exist 25 years ago. So
Right.
this unparalleled information technology, but core semiconductors, core access to the cloud, core computational power is available along with their access to other entrepreneurs that join them in their journey means that you can build something faster and a little bit cheaper. The markets themselves are still just as big as they were. The markets themselves are actually much more aware of their carbon intensity than they ever were. We are a climate fund. We actually measure and provide metrics to our LPs for our GHG impact reduction. It is the first hurdle for any of our investments, and we get paid partially on our impact performance. But I will give all the credit in the world, having been an entrepreneur, to the entrepreneurs that we see coming through our door. They're so much more ready for the game than they were 25 years ago.
Right.
And it's a public awareness too, right? I mean, if you think about it on the climate side. We were talking earlier.
Yeah.
You got 4 kids in their 20s. I have 3 kids in my 20s. None of my kids own a car. And they don't want to own a car, right? They're just the different generations. I think it's really exciting. So.
Well, different generation and a priority set that has them being thoughtful about these very issues.
Yeah.
But there are challenges out there in the market, right?
For sure.
Undoubtedly so. And access to capital to some extent is, and just attracting capital to the industry and
Yep.
what does it mean is one of those challenges. And also in the industries that you look at, I mean, you mentioned the regulatory environment and government policy and support. You don't underwrite to it, but it exists there.
Right.
And so how do you think about those challenges when you're looking at an investment that clearly has a component to it that could be variable based upon policy decisions? How do you disaggregate those things?
Yeah, that's super hard. And that's why I say fundamentally we don't underwrite to it.
Yeah.
I'm not a big fan of executive orders that go
Right.
away just when you think they're in the bag. So I much prefer legislative tailwinds that have legs to them. And yet, your question preloaded the notion of, is the capital market in general, from the first domino to the IPO, is it flush and full, and does it have an aligned set of interests? We actually think it's a lot better than it was 20 plus years ago, right?
Yep.
In 2012, I remember chatting with Ira about joining his great firm, and somebody said to me, he goes, well, if nobody wants to invest in clean tech anymore, Mark, what are you going to do in venture? And I said, well, I'll just go back and get a real job again, right? I mean, I didn't know. I wanted, and I was passionate about the climate space. Today, when I think about past versus today, there are plenty of good and high caliber venture firms.
Yep.
Specifically, there is an amazing revolution or evolution in the corporate venture practice. Mm-hmm. I couldn't imagine the number of CVCs that have hired the right people, have built what I would call hopefully a long-term playbook for this. I couldn't imagine that 20 years ago. Right. So it's congrats to the CVC engagement that we've been able to have. And then the private equity world has woken up.
Right.
You know, if you talk to the TPGs and KKRs and big infrastructure funds, they get it and they see it. We actually think there's still a little bit of a gap. We actually think this sort of late stage VC pre-big private equity, there's a gap that somebody might have called the valley of the death 20 years ago.
Right.
Today we just call it growth capital. And we think there's a real nice niche there to actually make sure that you can participate as a venture firm, look at how innovation gets evolved into potential winners, and then be able to put additional capital into the incubated winners then in the space. So I think we're in much better shape. I mean, I don't want to sound Pollyannish about it, but, and we certainly are in a bit of a reset on post-2021 valuations.
Yep.
And it takes the private markets a lot longer than the public markets to capitulate on valuations. And I'm not saying that we're driving that, but I think there's an awareness.
Part of that conversation.
It's a two-sided marketplace.
Absolutely.
You have to be aware on both sides for an agreement. But I think that is a good correction for us.
Right.
It's a good correction for us. And I think what we will see over the next 10 years is actually financial returns as these big markets dislocate. The innovation is there. I see it. I see the decarbonization commitment at the corporate level, not just with our LPs, but all of our international partners that we have today.
Right.
So I'm actually bullish at the moment.
Well, no, that's excellent. And we see the same thing, this sort of reflection of what's happening in the market. And it's not per se a shortage of capital. It's a shortage of understanding what the inherent risks are and figuring out along this risk profile where different pockets of capital are going to come in. So to some extent, the magic may be, as you said earlier, commit for the long haul, because there's going to be a gap that you're going to find somewhere along the way in the capital stack. And it could be a question of just time, as we see an interest rate environment actually having the traditional infrastructure funds and private equity pull back more towards the market, because frankly, debt's not free anymore. Right. But you want it to be an episode, not a conclusion. So you want to make your way through that and then get yourself on the other side.
It's a long game. Yeah. Right? Somebody asked me about, like, how do you forecast and underwrite? We always ask our team to tell me what the future looks like. Not 18 months from now, but 12 years from now.
The future.
If you go back and look at people who were good prognosticators of the future, whether it be climate tech or just in innovation in general, often the more accurate forecasters were science fiction writers, more than private equity firms or investment bankers or anything else. And I remember we have 4 taglines we use at CI for the team. The first, and I stole these from all of my former firms, except for one, right? But like Ira and I used to always sit around and just say, imagine a future when, and then just fill in the blank. Right. And then I remember at Steve Foster at PIVA is a good friend of mine, worked together. He always used to say, Mark, what do you have to believe? Right? What do you have to believe? Right. Lastly, at Vantage Point, it was always like, just bet on the inevitable. Of course, the question is, what the hell is the inevitable? But just bet on the inevitable.
When the inevitable comes, right? It's the
and then for us, I've always asked my team, just tell me what happens when. Right. And if you can live into those 4 questions and come up with answers, I think you can usually develop a pretty good thesis for backing innovators. So, I don't know.
Fantastic. Well, honestly, I couldn't think of a better way to bring things to a conclusion in our conversation today.
I think that 000.
Yeah, I noticed that.
In
big red, by the way. So,
happy if any of my CI colleagues, you want to ping them out and hit them up, or myself to engage the rest of the week. And it was great to have you on.
No. It's really been my pleasure, Mark. Thank you. So, next to all of you, please. Thanks.